Wow, Salesforce just delivered its second best trading day literally in the company's entire history, surging an absolutely incredible 22% on the back of a single earnings report. Let's be real, for a company of this massive scale, moves like that just do not happen without a fundamental shift in the underlying narrative. So welcome to our explainer. Today we're going to break down exactly what drove this massive pop, separate the reality of their AI monetization from the hype, and give you an objective, purely data-driven look at this pivotal earnings report.
So here is the multi-billion-dollar question we have to answer. Is this a sustained breakout or just a short-term pop? For the past 18 months, Salesforce has been stubbornly labeled by the market as a value trap. The stock was trading at historic lows while investors essentially just sat on their hands. They were waiting for concrete proof that artificial intelligence could actually drive top-line revenue and wasn't just, a collection of earnings called buzzwords. So did they finally escape that narrative for good, or are we just looking at a temporary sugar high before more pain?
Okay, let's dive right in. Here's our roadmap for this explainer. First, the Salesforce setup. Second, unpacking the numbers. Third, the AI catalyst. Fourth, the bear case. And finally, the final verdict.
Starting off with Section 1, the Salesforce setup, from value trap to breakout.
Like I mentioned right at the top, a 22% single-day stock surge completely redefines a company's momentum. What the market saw in this report was a glimmer of something it has been desperately searching for across the entire software sector: the promise of real, quantifiable AI monetization. The narrative literally changed overnight, from prove it to us to, whoa, they might actually be doing it. If you're investing in software, this is exactly the proof of monetization you've been waiting for. But to understand if that 22% premium is actually justified, we've got to look closely at what happened on the balance sheet.
Let's move to Section 2, unpacking the numbers, with a healthy dose of intellectual honesty.
We'll start with the headline figures, but we absolutely have to apply a critical filter here. Top-line revenue came in at $11.35 billion, which is up 11% year over year. Solid, for sure, but it's not the real story. The financial media ran wild with the GAAP earnings per share, which came in at $5.90. That represents a massive 80% beat over consensus estimates. Sounds explosive, right? Well, actually, scratch that. We need to practice some intellectual honesty here. That $5.90 number includes a massive $2.6 billion one-time paper gain from Salesforce's investment in Anthropic. When you strip that paper gain out to see how the actual core business operated, operating EPS was roughly 3.37. Comparing that to the 3.27 estimate, we're really looking at a 3% operational beat. So still a positive beat, but certainly not the historic blowout the headlines might have you believe.
But hey, even with that optical illusion on the EPS, the core fundamentals underneath remain exceptionally strong. Operating margins successfully expanded, their free cash flow yield now sits at roughly 8.7%, which is just an exceptional figure for an enterprise software company. And perhaps most importantly for the valuation, the forward price-to-earnings ratio is sitting around 14 to 15 times. That is a notable discount to the broader S&P 500 and a mere fraction of Salesforce's historical average. So the big takeaway here is that on valuation, this stock is still priced for skepticism, not for perfection.
All right, Section 3, the AI catalyst, featuring Agentforce and Claudeforce.
Now this is where it gets really interesting. $1.5 billion. That figure shows exactly why the stock really moved. Agentforce, Salesforce's flagship AI platform, just hit an astonishing $1.5 billion in annual recurring revenue. That is a staggering 240% year-over-year growth rate. Let's be real, this is the exact metric the market was hoping for.
But we need to put that $1.5 billion into perspective because the quality of this revenue is absolutely crucial. These aren't pilot programs, they aren't extended free trials just to juice the user metrics. No way. This is paid, recurring subscription revenue from serious enterprise customers. In a single quarter, Salesforce successfully signed 98 different Agentforce contracts that were worth over $1 million each.
As the source material points out perfectly, and I quote, "That's enterprise buying behavior. That's CFOs signing checks." When actual financial executives are willing to pull the trigger and allocate major seven-figure budgets to an AI platform, it validates the product in a way that marketing hype simply cannot.
Then we have the expanded partnership with Anthropic. The market has cheekily nicknamed this Claudeforce, but the revenue potential is dead serious. Salesforce is integrating Anthropic's Claude AI directly into 37 of its pre-built sales tools. Why does this matter so much? Because it embeds AI seamlessly into the daily workflows of over 150,000 Salesforce customers. When you lower the friction of using AI, you drastically increase product stickiness and you open up massive cross-sell opportunities across the entire ecosystem. This marks the very first time we've seen a legacy enterprise software company successfully translate widespread AI hype into actual dollar-based recurring revenue at this kind of scale.
Which brings us to Section 4, the bear case, what keeps us honest.
Any solid investment thesis has to be able to survive the bear case. So the crucial sticking point for skeptics right now is what we call the CRPO gap. CRPO stands for Current Remaining Performance Obligations, and it's a vital forward-looking revenue metric. Right now, CRPO has not accelerated at the same rapid pace as Agentforce usage. In plain English, while customers are absolutely using these AI tools way more frequently, they aren't necessarily committing to bigger, longer-term contracts just yet. This creates a conversion gap that we really need to monitor very closely over the next 2 quarters.
And Wall Street certainly isn't throwing a unanimous parade here either. Bank of America has maintained an underperform rating with a $160 price target. Morgan Stanley has an equal weight rating with a $235 target, which implies very limited upside from current levels. Their primary argument? While the AI revenue is growing fast, it is still just a tiny drop in the bucket compared to Salesforce's massive $35 billion base business. Combine that with ongoing macro pressures tightening up global IT budgets, plus the very real execution risks of scaling Agentforce globally while trying to maintain margins, and you can easily see why some analysts remain highly cautious. Salesforce has a history of complex integrations, and flawlessly executing this global AI rollout is going to be a massive operational challenge.
Finally, Section 5, the final verdict, weighing the risk and reward.
When you place the bull and bear cases side by side, it brilliantly illustrates where the true opportunity lies. The bull case offers a historically cheap valuation at 14 times forward earnings for a company growing top line at 11% and AI revenue at an insane 240%. If they hit their fiscal year 2027 guidance, fair value estimates sit around $310, implying an enormous 50% upside from pre-earnings levels. But the bear case pushes back hard with that lagging CRPO metric, very real macro IT spending headwinds, and the fact that the massive EPS beat was optically inflated by those paper gains.
So, based on the data, the recommendation outlined in the source briefing takes a very clear stance. Step 1 is acknowledging that the market is currently pricing in execution risk rather than assuming future success, which gives us a nice valuation cushion. Step 2 is to initiate or add to a position at these current levels, capturing the upside of their highly differentiated Anthropic partnership. But Step 3 is your safety valve. You must strictly monitor that creepo growth in the next earnings cycle. This matters immensely. If creepo accelerates, the stock re-rates much higher, rewarding those who accumulated now. But if it disappoints, that triggers a major reassessment.
Let's leave you with this thought to consider. This entire earnings report is really a story about a mature, legacy enterprise company proving that it can pivot and innovate at scale. And frankly, that is incredibly rare. As everyone looks for the next shiny new AI startup, it begs the question: are legacy tech giants, with their massive existing customer bases and deeply embedded workflows, actually the safest and most lucrative bets in the AI race? Thanks for joining us for this explainer, and definitely keep an eye on that CRPO next quarter.